Has the Fed lost control? Inflation's absolutely roaring back. Now back at 3%, up 70 basis points in the past 5 months, and with the highest semi-annual rate of change since the great inflation of 2022. Meanwhile, stocks, home prices, and gold are all smashing all-time highs, and yet you'll be shocked to see what the Fed is planning next. But wait, it might actually get even worse. So, of course, today we got CPI. Even though the government is shut down, they needed the data for the cost of living adjustment, and we now have CPI headline at a three handle. So inflation is now firmly at 3%, as we can see here. Inflation did come in cooler than the market was expecting, but as we will see in a second, it is rising over the past 5 months. So if we take a look at the components here, we can see core CPI here, the components. Services accounts for the vast majority of core CPI. Goods inflation is only about 39 basis points. If we look at headline CPI, which again includes food and energy, this is exactly what I've been warning about the past month or two. Energy is starting to tick up. Energy had been helping to actually keep CPI lower on the lower side, causing disinflationary pressure, but we are seeing energy start to tick up. The index for gasoline rose 4.1% just for the month of September alone, and energy overall rose 1.5% for the month. We can see again the same story. Goods inflation, that tariff related inflation, still not really showing up, only accounting for about 31 basis points or a tenth of the overall CPI index. Now, remember, it's important to point out that the average American does not feel inflation as a annual rate of change or certainly a monthly rate of change. They feel this. This is the consumer price index off of which that inflation rate of 3% is based. What that is telling you is that for the past year, inflation has risen 3%. The underlying price, as we can see, basically always goes up. The only question is how fast are those prices going up? And we can see for the past 5 months, inflation has been actually heading higher. So not only are prices perpetually going up, but the rate of that increase is also going up. And of course, consumers feel the cumulative rise of prices. As we can see here, headline inflation 3%, core inflation 3%, and core PCE, which is what the Fed uses, that is at 2.9%. Basically, we have inflation at 3%. The Fed's long run target is 2%. That is about 50% higher than the Fed's long run target, and yet they are cutting interest rates. And we'll take a look at what asset prices are doing in a second. But we can see the fastest 6-month increase for the headline CPI going back all the way to June of 2022 down here. So the rate of change over the past 6 months of the CPI headline index is at the fastest increase going back to June of 2022. Now, a couple other indexes with some notable increases include medical care, 3.3%, household furnishings and operations, 4.1%, recreation, 3%, and used cars and trucks at 5%. So I mentioned asset prices here. We can see basically all assets are at all-time highs. I would remind people that gold does not double in the course of a year or two when everything is fine. When inflation has been conquered, you do not see a gold price that looks like that. And I would also remind folks that if you invert that price, that is the dollar denominated in gold. So of course, most of us look at the gold price. Well, that is gold denominated in dollars. But again, the other way to think about it as an FX pair is to invert that, and it's saying the same exact thing. Gold dollar moving vertical like this is saying the exact same thing as dollar gold moving like this. This should be a concern for the Fed, but as we will see, it is not. They are planning, or Kalshi, the betting markets are planning for exactly 3 cuts for 2025. Today, we did see a bit of a bid into bonds, as of course, the data was cooler than expected. Now, inflation, the rate of change is going up and up and up and up and up over the past 5 months. In fact, the highest rate of inflation going all the way back to January. But yet, because it came in lower than expected, bonds initially got a bid. However, they are reversing that, and we can see the yield curve is steepening just a touch. So if we look at how markets are responding, we can see the S&P 500 is gapping up, going absolutely vertical. VIX is, of course, down. Bitcoin not really catching a bid. Gold, of course, catching a major bid with a headline CPI print of 3%. And of course, we can see the 2, 10, and 30-year. The yield was initially down. Again, it was lower than the market had expected, but we are seeing some pressure to the upside in interest rates, and the dollar is basically flat on the day. If we look at the next Fed meeting coming up on the 29th, we can see a 96% chance of a cut, of a 25 basis point cut. And of course, the Kalshi bets we just looked at. This is why. This is why the Fed is cutting with inflation at 3%, no matter how you measure it. By the way, M2 growth, broad money supply is growing at 5% year over year. This is why. It is the debt. It is that fiscal dominance story that we've been talking about since the beginning of the channel. Here we can see our debt is growing at about 6.1% annual rate of change. Now, the deficit is growing at about 10, 11% year over year. And if we look at nominal GDP, again, what that is the nominal growth of the US economy, including inflation. We can see that is only growing at 5%. Now, 5% nominal growth is quite healthy. Again, post 2008, that is actually a quite strong nominal growth rate. The only problem is the debt and the amount of leverage in the system. So I used to show this chart a lot. Here we'll look at it again. Here is debt to GDP up top in blue. And then down below, we have the 10-year yield minus nominal growth. And a couple things to point out here. Debt to GDP, or the debt load, the debt burden for the government, gets worse when the cost of the debt, as proxied by the 10-year interest rate, 10-year yield, when the cost of the debt is above the nominal growth rate, as seen in the red boxes, by the way, which generally correspond to a recession. When the cost of the debt goes above the nominal growth rate, you see debt to GDP go up. The debt burden increases for the government. Consequently, when the cost of the debt is below the nominal growth rate, as evidenced by the green boxes, we can see a decline in debt to GDP. The debt load actually gets easier for the government. Here's another way of thinking about it. They need negative real yields. I did a whole video on real yields that I'll link at the end of this. But very simply, what this is the 10-year yield minus inflation. And what we can see going all the way back to the early 1900s, the last time the debt to GDP was above 115%, was World War II. And the way that they dealt with that was negative real yield. So what they did is they ran the economy very, very hot. And of course, the yield on the bonds, short-term bonds were capped at, I think, 50 basis points. Long-term bonds were capped at about 2.25, if memory serves. And so what they did is yield curve control, where they said interest rates cannot go higher than that. If they do, we'll buy the bond to bring it down. And then they ran the economy super hot. In fact, nominal growth was like 20% at one point during the deleveraging following World War II. Inflation was 15, 16, 17, 18%. And the interest rate on the debt was only 50 basis points, or 2.25, much, much lower. And so that is what we're looking at here. Of course, the dotted red line shows 0. So anything below that dotted red line is a negative real yield, meaning inflation is higher than the interest rate on the debt. And of course, we had that recently. This helped a bit to bring debt to GDP down here when we had those negative real yields. However, real yields have turned positive once again, and the government cannot allow that. That is why they're issuing so much debt at the short end of the yield curve, which they can control. And so by doing that, we are kind of admitting that we are entering this fiscal dominance regime of just run it hot, whether that be inflation, nominal growth. It's all kind of the same general thing, which is they're going to run it hot, whether that means more bill issuance, which again, bills are more money-like, they are more cash-like, it's more stimulative, they're less volatile, more readily levered into new U.S. dollars. Of course, treasury bills and treasury bonds, notes being the collateral for the financial system. So not only is that stimulatory, but shifting the more issuance into bills is also stimulatory. And then, of course, they want to cut the federal funds rate to get the interest rate on those short term bills below inflation. That is the goal. Financially repress the bond market. That is the fancy term, the technical term for negative real yields. You are forcing bondholders to take a loss. Now, they get paid back every single dollar that they're owed of principal, and they get their interest. The only problem is that once you account for the cost of goods and services that have gone up over that time period, you've actually lost purchasing power. And I just want to end here by showing that ISM services prices lagged by 3 months, pushed forward by 3 months, excuse me, is a very, very tight correlation for the CPI inflation rate. And as we can see, it has been vertical. Over the past 2 quarters or so, we have seen the services ISM prices component move dramatically higher. Now, remember, about 70% of the US economy is services. And of course, manufacturing prices have also been moving sharply higher with ISM as well. Forecasting, again, pushing forward that ISM services by 3 months, you generally start to see it in CPI inflation. So it might actually get even worse, but it was baked in the cake, given the amount of leverage that was accumulated by the government here in the U.S. This was kind of baked in the cake. They needed to financially repress the bond market. They told you back in May or June, we're going to run it hot. Elon Musk, Scott Bessent, and David Sachs, they all came out and they all said, yep, you got to grow faster than your debt. Well, of course, we can go back to this chart. That is what this is representing. And one of the components is inflation. Remember, nominal growth is all that matters from a debt standpoint for the government. One of the components, it's real GDP plus inflation. So we have pretty decent real GDP if we have higher inflation as well, and they are able to get those short-term interest rates lower. They can run negative real yield and try their best to de-lever the debt. The only problem, there's always a release valve, and that release valve is likely assets. And we can see that, of course, not only today are assets ripping higher, but they have been already ripping higher. And of course, gold, I think, is sending a clear signal about what this is going to mean for the dollar. So anyways, hopefully that was helpful, and I'll catch you in the next one.